Good afternoon. My name is Jillian DelSignore, Head of Retail and Wealth for Nasdaq Index. Thank you so much for making the time to join us this afternoon. I'm very pleased to be moderating our discussion today. Could silver and its miners shine in today's markets? With our expert from Sprott Asset Management, who I'll introduce in just a minute. But before we get started, just a couple of housekeeping items. Number one, there's a console at the bottom of your screen, of which Sprott has put some materials in for your use. You're going to find a fact sheet on the product we're talking about today, a prospectus, the landing page, and also the deck that Steve is going to run through here this afternoon. There's also going to be a survey that takes place at the end of the webcast. It just takes a couple of minutes, and we greatly appreciate your participation because it only helps make these webcasts more valuable to you in the future. So thank you in advance for taking the time to complete that as we get through the time today. We are going to try to leave time for questions at the end of our time together. We do only have 30 minutes, so it's not usually likely, but please do put your questions in the Q&A box regardless, because if we don't get to your questions, someone from Sprott will reach out to you directly to answer it, even if we don't get to it live. So let me go ahead and introduce our speaker for today and welcome him in to start taking us through the presentation. So Steve Schoffstall is the Director, ETF Product Management at Sprott Asset Management. Steve, welcome to the conversation today.
Thanks for having me. It's great to be here.
Why don't I let you go ahead and start taking us through?
Sounds good. So if we could just kick off on the About Sprott slide. Just for those that aren't familiar, Sprott has 4 decades of experience in the metals and mining sector. Initially, that was focused on precious metals, but over the last 4 years or so, we've really started to move into the critical materials space. We have about 11 ETFs listed in the United States, a number of closed-end funds listed in Canada. The bulk of our assets are in the exchange-traded product category. We also do have some managed equities and private strategies that we have available as well. So with that introduction, we'll just jump right into things. We'll move through some of these materials more quickly than others. So first, we'll touch on the monetary case for silver, and then before getting into supply and demand considerations, the opportunities for silver miners, and then we'll talk a little bit about the Sprott silver miners and physical silver ETF. So we'll get started with taking a look at the historical price view of silver prices back through the turn of the century. I think one thing that generally gets lost when we start thinking about prices and looking out at a bigger picture is we tend to get caught up in the volatility of shorter term price movements. But if you look at silver since the turn of the century, it's actually returned an annualized rate of about 7.6% per year for the last 25 years. And as far as the price of silver, it was about less than $5 an ounce at the turn of the century before hitting a high of $48 per ounce around 2011. Today, we sit somewhere around $32 to $33 per ounce. Falling prices in the commodities markets in the 2010s really resulted in underinvestment in a lot of commodities, and silver was not unaffected by that. We're seeing some of the fallout from this underinvestment today, and we'll talk through that as we go out through the webcast. Year to date, physical silver is up about 13% and has outperformed the S&P 500 by about 17%. In spite of silver's strength this decade, we're still a ways off from testing that all-time high that we saw back in 2011. So moving to the next slide, we'll just take a look at silver and its unique qualities as both a precious and industrial metal and what that might mean in the current environment. Because it is a precious metal, it does have some of those same attributes that you would expect to see, with gold. And one of those things is that it tends to benefit during periods of market uncertainty. With that, we see periods of decreasing inflation and the opportunity for lower interest rates tend to be a bullish indicator for silver as investors can look to the industrial side or also the precious metal side to take advantage of that. On the next slide, we'll just take a quick look at how silver has performed over easing cycles. So historically, going back through the last easing cycles that we've seen through this century. We saw the Fed cut rates in 2001, 2008, and again in 2020. What we've seen out of silver is that it's reacted strongly after each of those cuts. Performance over longer periods have ranged from about 143% after the most recent round of cuts up to 441%. Where we're at today is that the market is actually pricing in currently 3 rate cuts that are expected through 2025. On the next slide, we'll just take a quick look at how silver and gold tend to react on a relative basis. Silver does get lumped in with gold because those are the 2 primary precious metals that investors view as safe havens, and those safe havens tend to do well during periods of currency debasement, inflation, interest rates that are following economic recoveries, and I think something that we're all very familiar with at the moment, rising geopolitical uncertainty and the risk around geopolitics. If we look at the precious metals bull markets going back to 1970, what we tend to see is that silver outperforms gold by about 1.9 times on average over each of those bull markets. In the current bull market that we're in, we're pretty much on par with the price of gold on a relative basis, even though the gold has gotten a lot of the attention and the vast majority of the media coverage in the last couple of months. Silver has really kept pace with gold if we look at a little bit longer perspective. Historically, what we do see is that gold prices tend to rally before silver, and then silver will eventually pass gold, and then it tends to conclude its rally a little bit earlier. That's what we've seen played out historically, and is one of the reasons why we think silver may not have kept pace with gold year to date or during the current environment to that what we've seen on the historical average of about 1.9 times outperformance. So flipping to the next slide, we can take a look at one of the common relative measures between gold and silver, and that's the gold to silver ratio. And quite simply, it's just a measure of how many ounces of silver it takes to buy an ounce of gold. If we go back 45 years at the start of the 80s, the average ratio was about 67, so 67 ounces of silver to buy 1 ounce of gold. What we have here in the chart is it shows 92 as of the end of last quarter. This morning, we're actually at closer to 103 ounces of silver for 1 ounce of gold. So that's significantly higher, even what we've seen from the end of the last quarter. And in our view, this could pose a potential catch-up opportunity for silver to catch up relative to gold. On to the next slide. Not only is silver cheap relatively compared to gold, but inventories have actually fallen by about 22% over the last 5 years as we've seen increases in industrial demand. Much of the London Bullion Market Association's inventories are actually allocated to ETFs and other funds, so they're not readily available to industrial uses. This will be an important thing to remember as we move throughout the webcast and start focusing our discussion on supply and demand dynamics. So if we look at some of the uses of silver on the next slide, there's actually more than 10,000 uses, and they range everything from medical purposes to nuclear energy, where the control rods are about 80% silver. We see because it is the most conductive metal in existence, we see a lot of uses in electronics, in semiconductor chips that are used for artificial intelligence. So very wide-ranging metal with lots of uses. Because of this, we've actually seen industrial demand for silver increase to account now for about 59% of overall demand for silver. If we were just to look at 2023, it was 55%. So even in the last year, we've still seen considerable demand coming from industrial applications. On the next slide, we'll just take a look at kind of what this means from a percentage basis or from a practical basis. The silver industrial demand in last year actually increased by about 681 million ounces. A large account of that growth came from electrical and electronics. So when you think of electrical, that would be things like AI data centers, power grids, 5G networks, and solar panels, where silver is needed to take the energy from the sun and convert that to electricity. We've seen considerable demand increase, particularly in solar panels in recent years. And now together, the electrical and electronic sectors now account for about 40% of total demand. Moving forward to the next slide, looking at electricity growth, and this is one of the drivers that we see for a lot of critical materials, and silver is no different in this case. We're expecting to see about a 169% increase in electricity out through 2050. A couple of factors that are leading to this would be one, We do have rising middle classes in developing countries. So as they're starting to urbanize and get more technologically advanced and industrialized, there's additional demand for electricity to keep those economies moving and progressing. And then in more developed countries, we're seeing increases in electricity as technological advances like artificial intelligence are starting to take hold. We also see EVs playing a significant factor of electricity needs. So all being said, so we have those two main factors underpinning electricity growth. At the same time, there's a global push to change the way that we consume energy to more cleaner forms of energy. So the energy transition, this is a very much a critical materials heavy endeavor. And that's something that we're seeing about $2.1 trillion actually invested just last year alone in the energy transition. So when we start hearing things about weakness in the global economy, this is an area where we see that investment in the energy transition does provide a level of support for a lot of these metals like silver or even copper or some other critical materials that might not have been there 10 years ago. On the next slide, we'll just take a look at solar panels and what that means for silver. This is one area where we've seen a lot of growth in the demand and also in the amount of solar panels being produced. The global solar panel additions actually grew by about 35% in 2024, which is above its average of about 30% if we were to go back over the last decade. So very robust growth that we see in solar panels and solar usage. This is having some massive implications for silver and silver demand. Solar now accounts for about 17% of total silver or total demand for silver, whereas if we were to go back to 2016, it was only about 8%. So a lot of the driving that we see comes not only from solar demand, but also the broader move to electrification and also greater technology uses. On the next slide, we'll take a look at overall demand. And one thing to note here is that silver investments, so thinking of ETFs or coins or bars, make up about 16% of demand. And what we typically see from the ETF side of things is that buying has historically increased in monetary easing cycles. So in our view, this could provide another tailwind over the shorter term. And then also, if we look at kind of geographically, silver in the East is correlated, or increased silver buying in Eastern economies is correlated with the rise in demand for silver. And we're seeing buyers that are actually paying a premium of up to 7% to make sure that they can secure the silver that they need to keep the industrial engine moving. On the next slide, well, at the same time that we're seeing increases in silver demand, we're also seeing a supply picture that has been stagnant for pretty much the last decade. If we were to go back to 2016 and look at what we produced then versus where we're at now, we would see that supply has actually decreased by about 4%. Some of that is attributed to the difficulties that we have increasing supplies, whether that comes from investment in silver miners that I mentioned earlier, where we had that decade where there wasn't enough investment happening. We also see long lead times to open mines and degrading ore grades, which are making the silver coming out of the ground much less prevalent than historically what we were seeing. Also, recycling accounts for about 19% of supply, so it's been relatively flat in recent years, and that's not really enough to close the gap. So if we were to look at where we're at today on the next slide, rising demand and stagnant supply has really pushed the market into a supply deficit, which we've seen over the last 6 years and would expect to see that in 2025 as well. The 2025 deficit is forecasted to be somewhere around 190 million troy ounces of silver, so very significant supply shortfall. In a couple of minutes, we'll walk through a few slides and we'll discuss why increasing supply isn't as straightforward as it seems. But with that, we'll shift our conversation now to the silver miners and take a look at the opportunity there. A lot of the focus in silver investing historically has been on physical metal, and that's what investors are most familiar with. And while we believe that the physical aspect of silver investing is has a place as a core holding in portfolios, we're seeing more and more investors starting to take interest into silver miners and considering adding them to portfolios as well. Given the supply and demand picture that investors, or the supply and demand picture, we think investors may be well suited to consider miners. One, they tend to outperform silver during rising markets. That's something that we're seeing year to date and over the last year as well. But they also do, and that's because they do provide that degree of leverage to the underlying commodity itself. So moving to slide 21, similar to what we've seen with gold miners, silver miners do offer some diversification relative to other major asset classes. We would classify it as a low to moderate correlation to most major asset classes. And of note, more recently, if you look at the US dollar correlation, there's actually a fairly strong negative correlation there. That given the current market environment, we're hearing more and more from investors. They find that as an appealing aspect of silver miners. Moving to the next slide, one of the interesting pieces of silver mining is if we look at the cost to mine silver and what that means for miners. So if we look at pure play silver mines, and that's a term you'll hear later as we talk about the fund itself. When we talk about pure play, what we're really talking about is those companies that have at least 50% of their assets tied to mining silver. How that relates to the costs of mining, if you are a pure play miner, you typically see that your all-in sustaining cost of mining is right around $14.60 an ounce, which is well below the current price of about $33 we're seeing today. On the next slide, we'll just, we'll take a look at what's probably one of the most important slides if you're considering a silver miner's investment. And that is going to be, come into play when we start looking at how SLVR, our silver miners ETF, is different from some of the other strategies you might see. But in our view, identifying those pure play miners is of utmost importance. And that plays a very significant role in silver when you consider that 72% of silver is actually mined as a byproduct, meaning that miners are actually mining lead or zinc or copper or another metal, and they just happen to also have silver there as well. So that's an important distinction, that byproduct nature versus being a primary target of silver miners for two reasons. The first would be that, if you're targeting lead or zinc, there's going to be vastly different supply and demand characteristics to get those metals versus silver. So for example, if you're looking to use zinc, that could be very dependent on global economic conditions, whereas with the monetary aspects of silver or the energy transition usage of silver, that might not have the same impact on silver as other metals. So that can make it difficult for the amount of silver being produced to be scaled up, as that's not the intended target. And then secondly, it really ties into that last comment, is that because silver is a byproduct metal and miners are there mining something else, they're not going to really have silver prices impacting their mining decisions on mines where silver is not the primary driver of their activity. And just to, one stat that's, quite eye-catching is if you think of the 10 largest silver producers, 0 of them are actually principally silver miners. And that's a very important distinction when we start looking at different ETF strategies of pure play versus non-pure play, and we'll talk through that in a moment. But I think, to kind of put a bow on this slide, investors would do themselves well to actually take a more targeted approach to silver miners, and that can decrease their unintended exposures to other commodities that they may not want exposure to or already have exposure to. So we'll just move forward quickly here, and we'll try to leave a few minutes for questions. But we'll talk about the Sprott Silver Miners and Physical Silver ETF. This is a product that we've brought to market in late January, and the assets from a good standpoint are already outdated here. That we have it listed at 40 million. We're actually closer to about 60 million as of this morning. So we've seen a lot of investor interest in this space. When we look at our investment product lineup, anytime we go to launch a new product, there's a few things we look for. One would be, can we bring our expertise in the metals and mining space to whatever product we're looking to launch? Second, we also do a look at all the existing products out there and see if there's any gaps or ways that we can bring our experience into the ETF wrapper and improve investor outcomes. And then lastly, we're also looking for long-term trends that we believe exist in the market. In this case, in silver, we believe there's a long trend there. It matches what we've done historically from our background in metals and mining. And we think we have a product that's very much differentiated. When you do look at SLVR, one of the differentiating factors is that it does have a dedicated exposure to physical silver. That's going to make up about 17.5% of overall exposure. This is an index that's reconstituted twice a year. So there are fluctuations in that physical silver exposure, but at each index rebalance in June and December, we're going to see that get rebalanced back down to 17.5%. So that's one key distinction. The other key distinction is the fund focuses on pure play miners. Again, that's those companies that have at least 50% of their revenue or assets tied to mining silver. That's a key distinction when we start looking at comparable ETF, silver mining ETF strategies that might have a less stringent criteria and include companies that are just merely involved in mining silver or exploration. And if you recall from the previous slide, 0 out of the top 10 silver producing companies are principally silver miners. These are those types of companies that you'll often see in other strategies. And then some of the screens that other strategies might have is that, to be considered a silver miner, they just have to have a significant market share of the overall silver market. Again, they're not looking at a principal silver company. In some cases, exposure to silver miners in some ETF strategies could be as low as 8 to 10% on the individual company basis. So very, very much a lot of exposure and unintended exposure to other commodities that's present in some products. So that all sounds well and good, but what does that mean from a practical standpoint? When you look under the hood at SLVR strategy versus the strategy of other ETF strategies, typically what you'll see is SLVR has about twice the exposure to silver mining relative to other silver mining ETF strategies. There's very low overlap between SLVR strategies and other ETF strategies. And while silver doesn't have any exposure to companies with less than 25% of their revenue tied to mining silver, other ETF strategies could have up to 50% in this bucket, meaning you're investing in companies that, maybe principally a zinc or a copper miner that's making its way into your silver portfolio, which can really impact what we're seeing from a performance perspective and performance expectation perspective. We'll just move quickly, I think, to the next slide and just touch on a few things about the fund itself, and then we can open it up for questions. So currently, there's about 49 issuers in the index with a aggregate market cap of about $80 billion. With an average weighted average market cap under $3 billion. This does skew to the small cap spectrum, so about 60% small cap, 13% mid cap. So very much skewed to the smaller companies. That not classified exposure, what you're seeing there in the market cap breakdown, that's coming through the physical exposure that we have in physical silver. So physical silver is going to be about 21% based on kind of how the price has fluctuated. Again, each semi-annual rebalance that will get adjusted back down to its target weight. Other equities, that would be the ancillary exposure that we're getting from those non-pure play strategies or companies, or I'm sorry, not the non-pure play, but the weight in the pure play companies. So for example, if you have a company that gets 80% of its assets from mining silver, there's this 20% that they get from doing something else. That would be that 20% from doing something else. The index is mainly invested in companies that are domiciled in Canada, United States, and Australia are kind of the top three there, but very much a Canadian-focused ETF. With that, I think we can pause and open it up for any questions. We have a few required disclosure slides that we'll flip through just so we can keep everything moving there, as well as our standardized performance. Again, the fund just launched at the end of January, so there's not a lot of performance going back past inception. And back to you, Jillian.
Thank you so much, Steve. That was fantastic. And I'm sure that our audience does have questions, and in fact, they did put a couple in the chat. And I'm going to start with one that I wrote down. Why haven't silver prices kept up with gold?
And I think I touched on this a little bit, but gold tends to move before silver. And then when silver does move, it tends to kind of move past gold in its performance. That's what we've seen historically. Unlike gold, though, silver doesn't have central bank buying that we're seeing currently in gold. We're seeing, China in particular, and a lot of other countries that are looking to move to a de-dollarization, or they're concerned about, their reserves. Should there be sanctions? They saw what happened to Russia and what happens to other countries. Anytime that there's sanctions, it can be very difficult to get access to their reserves. So with gold, it's something that they can repatriate back to their home country. We don't see that level of buying in silver that we do with gold, and actually doesn't really exist on the central bank standpoint. Some of the muted price performance I think that we're seeing, and muted on a relative basis as silver's up about 13% year to date, is, I think some of that is kind of the old view of looking at the industrial uses of silver and expect, the fear of global slowdown in economic conditions, what that could mean for those industrial uses. I think the uncertainty around trade wars and tariffs also play a role in there. But I think what we'll see play out there is that, at least from the energy transition side, where we're seeing considerable demand growth come from, we think that'll also help prop up prices somewhat.
It's fantastic. We have so many good questions in here. So many people concerned about the tariffs and anticipated impact on demand and whatnot. I don't know if you have any thoughts while I'm looking through the rest of these on sort of that piece. I think you touched on a little bit just in your last answer, but
I think. I was just going to say briefly, if we go back, I think it was February when we started to see a lot of metal flow into the United States, getting ahead of expected tariffs. We've seen that subside and don't expect to, at least in the short term here. And a lot of the critical materials, which we view silver to be a critical material, things like copper, uranium, silver, we don't expect to see tariffs in any meaningful way that we're seeing with the so-called reciprocal tariffs that we see against a lot of countries.
Absolutely. So maybe we can wrap on this one. I think I always like to wrap with sort of implementation. And we had a question that came through. It's like, given its increasing usage as an industrial metal, how do we think about silver's role in a portfolio? So I'm an advisor on the line today. How do I think about that?
Yeah, it's a great question that we actually get a lot. And silver does have that precious metals component and its industrial uses. And I think, its role as a precious metal, I think that can potentially reduce the risk through diversification that we get through those low to moderate correlations that we discussed. So that I think you have a potential for asset diversification within a portfolio. The flip side of that is on the industrial side, it does open up for some growth characteristics. And we're seeing advisors now starting to use, silver miners and silver as a way to kind of dial up or dial back the risk tolerance to a certain degree, because it is lower correlated, but within, their precious metals portfolio, they can kind of use silver to try to capture some more of that growth while retaining some of those precious metals characteristics that people become accustomed to with silver.
That makes sense. Thank you so much. It's a great way for us to tie a bow on this. With 1 minute to spare, I will say thank you, Steve, and everyone on the Sprott team for bringing this idea. I think it's incredibly timely with everything going on, and clearly have a very engaged audience with us today. So thank you all for all of your really thoughtful questions. We did not get to everybody, but as I mentioned on the front end of this discussion, we will have someone from Sprott reach out to you to address the questions that you had for Steve, and we just didn't have the time to get to everything. So thank you again for your time this afternoon. We certainly hope you can take the time to fill out the survey so we can continue to make these very relevant webcasts for you as we move forward. Have a great rest of the day, and we'll see you next time.